Good morning.
Okay.
So, in moderator school, they teach you a lesson that there's really one job you need to get right, which is you need to get good panelists. And I feel like at this point, I've taken care of that, and I can actually introduce them and then go to sleep, and I will get an A+. So let me just go quickly. Uh-oh is not a good thing to say right now. So let me just go quickly through the panel. You know all these people. Because they actually require no official introduction, but I feel the need to do it. That's the second item they teach you in moderator school. And just going in order, Gene Ludwig to my left, who runs Promontory Financial Group, which is an IBM company. Betsy Graseck, leading bank analyst, managing director at Morgan Stanley. Tom Michaud, CEO of Keefe, Bruyette & Woods, should I say a Stiefel company?
Yes.
And to his left, Hans Morris, who's a managing partner at NISA Partners. And last but not least, only because of the geography, Deborah Matthews Phillips, who's managing director for payment strategies at Jack Henry and Associations. Third lesson they teach a moderator, which is start out with a superstar who's going to just lead us through a conversation, and we're going to do that because we're going to turn it to Betsy just to give us her overview of where the banking industry is today and where it's going, and then we can all run out and invest on that basis.
Okay, let's go. Thanks so much for that very rousing introduction there. I was asked to just give a little bit of a background as to how we're thinking about the bank stocks and bank earnings going into next year, right? Because we do have a lot of 2020 outlooks going on. I want to ground what I'm about to say in what bank investors care about, bank stock investors care about, because that's what I do. I cover US large cap bank stocks, and I'm also head of global banks and diversified financials at Morgan Stanley. So what we did about 6 or 7 months ago, maybe 8 months ago, is we asked the question, what drives bank stock alpha? What drives outperformance of bank stocks versus each other in a period when there's no credit problems, right? Because I think we can all agree credit's dead. Gene and I were having this discussion. Is it coming back, Gene? Well, no, don't just nod your head. Say
it's coming. The next 36 months.
But is credit's dead really the way you want to say that?
No, I wouldn't want to say that. No, I wouldn't want to say credit's dead. But I do think that we're, this cycle's feeling toppy, and you can't say when. I think we'd agree on that. 12 months, 24 months, 36 months. There are a number of things that could push it off the edge. But it's hard to believe that this thing goes on without some bump in the next 36-ish months.
Yeah, so it's interesting because it's been, 11 years already, and it's been phenomenal credit quality so far. And, bank investors, they kind of hate credit, but they love credit too because it gives them some alpha opportunity. So what do you do in an environment where there's no credit challenges? Well, what we found out is bank stock investors care about two things, ROE and operating leverage. And frankly, positive surprises in ROE are by far and away the biggest driver of alpha in bank stocks, but it was extraordinarily close, number 2, operating leverage. And we all know ROE can be, impacted by capital. So the operating leverage metric really is the most important and cleanest way to deliver positive alpha for your bank stock investors. Okay, why does that matter going into 2020? It's going to be a tougher year. Efficiency is going to be critical, and expense management, technology investment, all these things are going to be critical. When I think about what's going on for 2020, we have two issues which are a little bit of a negative, right? One, I think we all know, net interest margins, yield curves down, 75 basis points at the front end of the curve, 120 at the back end, year on year. I know the last couple of weeks it looked, a little bit better. Everyone's been like, oh, thank God. We're up on the 10-year yield from 1.4. We're back up to, we almost touched 2, right? So that's good from the last couple of months feeling. But year on year, we're down still about 120 bips. So revenues are going to be under a little bit of pressure because of the yield curve. And then we have CECL. Anybody heard of that? CECL. All right. So that is a big concern for investors because they're not sure how to model it. We all know day one impact ranges are in people's models, but how do we think about the future? How do we think about how to compare and contrast? How do we think about what bank managements are considering in that reserve? In other words, I don't know if net charge-offs go up 10 basis points or 20 basis points, should I keep my allowance level flat? If net charge-offs go down 10, should I bring it down? I mean, history is not going to provide that kind of anchor for us like it's been in the past. And importantly, you might also have heard of passive funds. I think we're going to talk a little bit about that too. The quants are a part of some of that passive fund activity as well. Quants use history. Quants use things like book value per share. Book value per share is going to be down for some institutions because of CECL. And you could say it's not fundamental, but the fundamental analysts are becoming a smaller and smaller portion of the overall market. So 2 challenges, yield curve and CECL. 2 positives, lending. Loan growth is actually accelerating a little bit, we think, going from 3 to 4%. I know that's lower than many people in the room, but we look at the overall group. So 3 to 4%, that's a plus. And that brings us to an outlook for revenue growth of about 2%. Well, and I should say capital markets flat. All right, our team's 2020 outlook went out yesterday, and we're looking for flat capital market activity. So when you pull it all together for us, 2% revenue growth, 1.5% expense growth. So we get that positive operating leverage that we're looking for. And then we've got provisions up, and you can throw darts at me, but we're 25% growth year on year in provisions, and a lot of this reflects that CECL question mark. So we've got operating earnings flat, we've got operating EPS up 5%. Okay, that's not a rousing cheer, but it's better than the rest of the developed markets, which are negative in Europe and just barely crunching over the 0 mark in Japan. Even China, you might be surprised, is that we're only looking for about a 6% EPS growth rate in China as well. So what does that mean? That means operating efficiency is the most critical thing on investors' minds. How you're using the technology, how you're investing in that infrastructure, how you're getting that incremental operating leverage is insanely important.
Tom?
Did I do it? Did I open it the way you wanted it?
Oh, it was way beyond my expectations.
Oh, all right, good.
Yeah.
Now I
But
can
you've
sleep.
you've set quite a floor for everyone else now, including me. I think I can't go to sleep because I just can't after that rousing rendition. Tom, you want to pick up though on the operating environment from your perspective?
What's incredible is how many versions I feel like we've had of it in the last 18 months. The Keefe Bank indices, both large banks and mid-cap banks, both peaked in the first half of last year. If you were at June 8th of last year when our regional bank index peaked, we thought there was going to be 11% earnings per share growth this year and next. Well, it turns out it's going to be 5% this year. So what happened? Third quarter of last year, expectations for loan growth came down. Fourth quarter of last year, the view on what the Fed was going to do changed. And we ended up being right into this environment that Betsy was just talking about, which is an environment that got to the summer where suddenly the recession word was being used a lot. So that, of course, brought credit back into play. And then we had this talk about negative interest rates. And negative interest rates, we did the work. Our view is if we get negative interest rates in the United States, that'll take 20 to 25% of the profitability away from the banking industry. It's happening in Europe right now. It's not even a test case. We actually have it happening in Europe. So investors this summer were really worried about the worst case scenario. And then bank stocks rallied. What happened? And I say inside the office, it's a lot like my golf game. It doesn't need to be better. It just needs to be less bad. So the outlook for the banking industry got less bad. Less talk about negative interest rates, long bond closer to 2 rather than 1, and we had a little bit better view about the economy. What's really interesting is when I'm out talking to bank CEOs around the country, I ask them what their clients are telling them. Most of them say it's better than what you see in the news. They say most of our clients are feeling pretty good about the economy. So I think the economy's been a little bit steadier than some of the real big naysayers might have been saying. We are hearing things about what the tariffs are doing. Specifically, I'm hearing about it from ag lenders, and I'm also hearing about it from other manufacturers who are starting to talk about they're really seeing it in some of their results. But I would say we are in a more challenging environment going forward now than we had been in the most recent past. And also, of that 5%, earnings per share growth we're looking for this year, almost 100% of it is due to share repurchase. So you could almost say it's nearly zero. And so the industry today is in a state of very high profitability. We've recaptured all our return on assets, all our return on equity, but really it's a growth challenge due to exactly like what Betsy was saying, which I think is going to have really big implications because the industry, and I know we're going to get to this in a second, is on a cusp of a lot of digital investment, and it's happening around the industry by the biggest banks. The other thing that's happening is, for the first time in my career, the bigger banks have gained scale and more profitability, and we could talk more about that, but there's an interesting shift happening in the operating environment and inside the dynamics of the industry.
I think maybe we should pick up on that topic, though, of you know, how the industry is segmented with what you see with bigger banks, profitability scale arguments and the like, versus the middle and smaller segment of the bank. Betsy or Tom or anyone else, if you want to pick up on that.
I'd just say the bigger banks had typically had less stock valuation and less profitability than the highest performing mid-cap and mid-sized banks in the country. That is now evolving and no longer the case. The bigger banks in general, some exceeding, some lagging, but have caught up, and the view of the future is that they're going to start to do better. Investors are on it. The PE ratio between the bigger banks and the mid-caps is at probably its tightest band that it's been at in years. And the price to tangible book of the two has really gotten closer. So really, and I think too, with a tougher yield curve, the more consistent non-interest income you have, the better off you're going to be. The smaller you are, typically the less non-interest income you have, and that's part of the math. And you're also less efficient if you're small or really small.
Yeah, I wouldn't bet against mid-sized and community banks going forward. We have a situation where, as these institutions begin to ingest technologies that are necessary, and that's going to be happening, they have serious competitive advantages that will begin to become more apparent. In the environment in which we currently live, the degree to which you can use social media, media generally, the internet, basically to project brand and also do things in an efficient fashion using advanced technology, you clearly have a leg up. But we're going to see that advantage be part of the community and regional banks increasingly. So fintech will change from being a threat, it'll always be a threat to some degree, to an enabler. We've just closed on, in a separate thing I've done, something called Canopy, what will be the largest fintech fund in the United States. And it is all focused on synergies for community and mid-sized banks, because there are a lot of these technology companies that recognize that they can get scale by being able to provide products for that segment of the marketplace. And that's going to transform the marketplace going forward. We're at a very interesting time in finance where we're going to see changes over the next couple of years that are just unfathomable a decade ago.
Maybe Deborah or Hans want to pick up on this, since we've worked our way into the tech theme.
Well, what I was going to talk about was providing some perspective, saying we're 10 or so years into this fintech investment, and 10 years since the financial crisis. Where are we? What have we learned? And so I want to take everyone back to 2009, 2010, and say what was that like? Well, first of all, you had technology changing. Principally, I say AWS, the ability to build infrastructure by the drink rather than have to spend tens or hundreds of millions of dollars to build that and invest that before you could actually launch a product. Second thing was you suddenly had, you had a supercomputer in your pocket, so the iPhone changed things in profound ways because it enabled you to have very sophisticated applications that could be pushed to the consumer. But I also think it changed the consumer's expectation of what a tech experience should be like. It curated that. And so now my 88-year-old dad gets all pissed off about all these forms he gets from Morgan Stanley. He says, just throws them away. He won't do it. And I don't think anyone will do it. I don't think this is a millennial issue. I think no one wants to deal with the frustrations and expects a very different type of expectation, has a very different expectation. So, and then what happened with the banks, if you think back, all financial services, is a bundled product. And generally, and this is something that John and Joe were talking about earlier, saying you either fit in the definition, you fit into that, or you didn't. And if you didn't, there are lots of fees and expenses, or you weren't allowed in. So if you had a salary, if you had a job and you had a direct deposit relationship, you could get credit, you had let's say 700 FICO score, you had a bunch. It was a very profitable relationship, but many people were either excluded from that or were just not well served by that. It was very expensive for them. So what's happened since then, I think, is fintech has fundamentally changed things, both helping some of the banks, so enabling banks, for example, to have digital mortgage origination or remote deposit capture, things which I think are really now table stakes for banking. And it's enabled them to understand risk better and police and understand the evolution of risk. But it's also enabled tech companies to go in and really serve many constituents much better and much cheaper. So you think about like gig economy workers and being able to small businesses which previously had very difficult and expensive origination processes or didn't have access to real-time payments. So the issue for us when we look at this, we say either banks have to look at the fact that the profitability of many of these core customers is going to go down because their expectations, many of these services are going to be free. Mm-hmm. They're going to, if you're going to send money to somebody else, that's going to be free. Their fees for robo-type advisors, many types of investing are going to be free. So that's going to change, and then the ability to cross, to charge large fees for some of these other underserved people is also going to change because they can get those services much cheaper other places and with much better type experiences. So we could talk more about that. I do want to, there's two areas where I think I want to come back to. One is cores versus wrappers, and how do banks modernize themselves faster, which I know you're going to talk about, but I have some thoughts on it. And second, I want to come back and talk about the issue of credit and capital and how it relates to many of these fintech business models, because that's the most important thing, which I think is going to be a major issue for the next year.
Hans, who's been extremely foresighted, I've got to say that, Hans, in this area, and really recognized before many others the power of the digital revolution in finance, I think described to you well, from my perspective, what has been happening and both what the threats and opportunities are. The next wave is going to be the transformation of not just the front office, but the back office for banks to get the efficiencies and also be able to deal with regulatory problems you can't otherwise deal, not only efficiently, you can't otherwise deal with them. We're living in a time where social media and the internet have magnified conduct events way beyond what would have been the case 20 years ago. You ask, well, why in Australia do they have all these conduct blow-ups? So, the banks in Australia all of a sudden decided to take advantage of their consumers that have been in existence for 150 years? No, it's because smaller incidents can be thrown onto the internet and magnified into very big things, and political leaders can't avoid addressing them. Mm-hmm. The only way to deal with that kind of problem is not scriveners and old policies and procedures. It is through technology, and there's a double opportunity: one, to deal with the problem, and two, to do it efficiently. And the only way to do that is with modern technologies, which are coming down the pike. So this next wave of this should be and will be the improvement through technology of the infrastructure of the existing financial system. And banking will benefit by that tremendously. It's enormously important, both from a regulatory perspective and importantly from an operational perspective. So that's what's coming. And we're just on the cusp of that really having an impact in terms of the bank operations, which, Tom, I would think, from your perspective, and Betsy, will make a difference at the end of the day in bank valuations as these things become more efficient, which is exactly, I think, where you two are going.
Yeah, and I think there'll be winners at each size category. It
Right.
won't be one rule fits all, certainly.
But one of the most important things is getting that real-time payment feasibility and functionality out there ASAP. I mean, I know this group knows that that's a priority, and I would think that it should be a priority of every bank, right, to enable that for their customers, because that's what the tech companies have the promise of, right? That's what they're suggesting to you in the other verticals that consumers, face their suppliers, right? Like, we're suppliers to a consumer lifestyle, so is Amazon. And Amazon's promising you, I'll get it to you in an hour. But they're also saying, look, you can get credit easily. You can have your funds transfer easily. And we have debates constantly with my team down the hall about how far big tech will come into the space. That would be another panel, so I'm not going to go through all of that at this stage. But
we're allowed to talk about anything we want to on this panel. That's the virtue of going first.
I will say, look, I spent a lot of time with our colleagues who cover Apple, and we worked on our Apple Card note with them. More than meets the lowercase I. More than meets the I. Get it? That was me. That was my. Boo. Oh, come on! It was a very cool title, and it got a lot of clicks. But my son, who's 13, he's like, "That was clickbait, mommy." I'm like, no, it worked. No, and it was great, and it's a great note, and it's really deep, and it gets into all kinds of detail, and a lot of it is assumptions because there's not too much data out there. But importantly, the message that I have is that yes, big tech, while they might not do exactly what we're all doing in the room, they want to take it as far as possible. And by the way, they're going to squeeze down margins as a result because they have tremendous market power, right? They have tremendous presence. Our estimate that's in this note is that Goldman will make a 1% ROA on the card. Now, I don't know 100% exactly what they're going to make, right? But based on everything we know about the product itself, we think that you're going to round to about a 1% ROA on the Apple Card product. We all know credit card is roughly a 2% ROA product, right? Round numbers. So that is telling you big tech's already in the room, okay? We can talk about the Google thing with Citi the other day, and to me, that's all about, hey, are the rules and regs around privacy going to be locked at the gate of banking, and when a consumer accesses a bank product through a Google Pay app, do those privacy rules go away? Question mark. We don't know exactly because 2020, it doesn't come out until 2020, so we can't see the legal document behind it. But they're already in the room. Even if they're using our rails, they're in the room.
Well, it's outrageous that the big tech and tech generally, what was the traditional fintech approach, has not regulated. The fact that banks are regulated and you have entities out there doing the same thing that are unregulated is a complete just disaster in our financial system. The good news for bankers is that will not last, either through vendor management rules or other regulatory necessities. We're going to see increasing regulatory focus on these non-bank entities. You saw it a little bit in the last few days. Yeah. And partly because they're not going to understand enough, they're going to stumble. So it's cold comfort that they're coming slower. They should have been on the level playing field to begin with. But that's coming.
Yeah, because this to me, this is my most important point that I'm going to make, and I think it's very important for all the banks. And the issue is, why won't this go on forever? In terms of, or what is the impediment? What's happening with all these tech companies? Well, what they're doing is, not Amazon, Apple, a little bit different, but definitely all the fintechs have to expand their revenue per customer. How do you expand your revenue per customer? You really have to get regulated. They know that. You have to get into the deposit system so that you can either rent the service from somebody else, but the problem is, if you rent the service from somebody else, you can't control the experiences well. It's hard to get the tech to do what you want. It's actually cumbersome because you have to go through all their credit committees. Everything the bank has to do, Apple has to do through Goldman. And so what many people are saying, we're going to get to our own charter, or we'll do more imaginative leasing of the different services. However, this is the key thing. If you're going to be a bank, or if you're going to be lending money, or if you're an insurance company, or you're taking other risk, you're warehousing risk. If you're warehousing risk, you need capital. Now you have regulated capital, but I'm chairman of the board of Lending Club. We proved like we're not warehousing long-term credit risk. We're not a bank, but we have a lot of risk. You have operational risk, you got liquidity risk, you got so things that we are talking about all the time. You have market risk. So the reality is a software company trades a software multiple because it's got 80% margins and doesn't have much capital and doesn't have much risk. There's not much variance. Once you get into these other activities, you need capital, whether you want a banking charter or not. So that's a very important fact, and I think the recognition when these companies go public, they start getting valued like people like Betsy and Tom look at them and say, well, I don't know, what's the ROE? And if you have a negative ROE, it's not a very valuable company.
Well, that's been a great moat, regulation and multiple. So regulation and multiple has kept big tech out of the process, and right, but they're impacting the profitability of what the banking system is offering. Again, given the fact that, look, what is Apple offering to Goldman? Half of the American population served on a platter, all right? I mean, that is worth something, right? That's worth a huge amount, and it seems to me that it's worth about 1% to ROA.
Yeah.
So, and then the next question is, hey, you've got people that are gonna be using this card, and they see no fees, and they see your rewards coming in immediately at the moment that you're paying. And I was talking to a colleague the other day who's like 20-something. She's like, I pay my credit card down every week. I was like, what? You're supposed to do it once a month. She's like, no, I like seeing that zero balance. I love it. So Apple Card enables me to do it easier, all right? So this is how it's impacting the returns, and it gets back to you gotta be efficient to deal with the fact that big tech is having on us, which is pressuring the ROE of the business.
So that's exactly, so the first two facts, one is this ROE and the impact of a balance sheet and why that's important. And then second, though, is what we call the denominator problem, which is, if you think about the pricing of a bank, your ROE is a function of bunch of customers, some of whom are bad in your denominator. So those are the people that don't pay you back, or they attrit, they do a bunch of stuff, they're just unprofitable, very low balances, bad. Bad customers don't leave. They're there forever. Good customers, who are part of your entire profitability, if just 5% of your good customers go and get the Apple Card, your ROE declines quite precipitously in a compounded rate. So the impact on no bank in this room can sit this out. You have to be improving customer experiences. You have to, when you have pricing, when you have illogical pricing, like a 2% ROA in the credit card business, it's like, well, that's not market. That's too high an ROE. Someone else will go in and take advantage of that margin. I personally feel late and over limit fees are in the same category.
And so, Deborah, you help banks do this, right?
Yes.
That's exactly
Yeah,
what.
so-
All right, Deborah.
That's okay. So I do want to agree with what you just said about customer journey. I think that this becomes very important for every single bank, whether you're a tier 1 financial institution or a $50 million credit union or in between. The focus on customer journey has got to be front and center, and that has to take place in understanding what technologies your customer needs. I think it was the CIO of IBM that said today's best customer experience is tomorrow's minimum expectation. And so, but it's got to be more than that. We know that today more than 40% of consumers have more than one deposit account. And so what's happening is, as Ron Shevlin says, they're accessorizing their accounts with other capabilities, and that's leading to fragmentation in the industry. And so from my perspective, as an advocate for community financial institutions, which is Jack Henry's sweet spot in the market, is that we have to focus on reducing the friction, and in order to eliminate that fragmentation, you have to deliver that local touch, but you also have to have the digital the technology that's hygiene factors, right? And the bar keeps moving because technology is changing, consumer expectation is changing, and so it becomes very important that you have the self-service, the digital transaction capability, the service capability for those mundane experiences. They have to be self-service because they don't want to talk to a person to get their balance or to check to make sure that a bill payment has been staged. But in that moment of need, when they want to talk to somebody, that's when, you know, the community financial institutions can play upon their strengths. We're starting to see that being embedded in technology. Some of the things that we're working on is having encrypted conversations in the chat experience, in the digital experience, so that people can talk to you about an account. They can give you the account number. They can send you a document. And so that's a nice way of blending the technology so that it's still a digital experience, but they still have access to a person that they need in that moment of need. And I think that's the way to win against the fintechs. And, you know, let's face it, that, you know, the fintechs are redefining the meaning of banking. And it's a threat that we all need to be taking very seriously, because you don't necessarily need a deposit account at a bank anymore. You can do banking in lots of other places. So, you know, it's a cautionary tale that we all need to be paying attention to.
Tom, you were going to say something right before I
was just going to say, we just talked about deposits, because the banks have customers, they have earnings, they have good regulation, and I think they've got confidence from just the community and stakeholders. Like Deborah was just saying, the fintechs have great technology, bring new experiences, but they don't have all the revenues, they don't have all the customers, they don't have all the regulation. The smartest thing to do is to bring it together, and I think that's what's happening.
Well, in an upside environment, and we've been living through an upside environment for the last several years, you know, innovations by regulated players has historically gotten a little bit of a boost. And any kind of new innovative product, the shiny new penny, the customer goes to it. In eras of increasing danger, banks have a competitive advantage inherently. People trust banks more net, and they should, deposit insurance and et cetera. I predict that as we see this thing crest, and as banks begin to ingest these technologies in a regulatorily sensible way, and you don't have discriminatory problems, because if you do this correctly with the correct partners, your own tech-enabled abilities, I think banks will come out of the cycle much stronger on the delivery side and efficiency side, ingesting the technologies, and that's going to be a transformational time in banking, which we're just entering into.
Should we talk about cores and core banking and wrappers? And so
Tread carefully.
Yeah, so I know, so I'm sitting next to the big core provider, but here's the issue. So I was at Citigroup.
I may have to separate the two.
Yeah, no, I actually, so cores, I think everybody here, who thinks they have a core problem? Nobody. I bet you're lying.
I paid
Anyway, so what's the problem? So you have, everyone has core systems, multiple core systems, which are systems of record inside the bank. And that has, over decades, been built up with lots and lots of functionality. So official check issuance in a branch, which stuff that is essentially irrelevant to someone who's doing a digital bank. So they're expensive, they're hard to change, they're batch, virtually 95%, I'd say maybe 100% of, close to 100% of banking customers today have batch core systems, which make real-time posting difficult. So the issue is, should you change your core? And the core providers are modernizing their cores. And I have always had the point of view, like, don't change your core. It's 2 years of analysis. At least, and then it's a couple of years of just writing your business requirements docs and everything, and evaluations, and then implementation is a couple of years. And a global company, it might be 10 years start to finish to completely change a major core.
Are you telling
system.
me core cannot handle real-time payments?
Cores are handling real-time payments, and they're doing it today.
But the core system itself, you got a wrapper, you got functionality which allows you to handle real-time payments.
We have built a payments hub, and we are public information. We have quite a few financial institutions that have signed up for RTP, more in the hopper. We're live with Zelle. And because of the way that we've designed our hub, the institution connects to the hub, and then we go out and connect to the various networks. So when FedNow is ready, we'll connect to that as well. making it easy for the community institution who doesn't have the resources to do the heavy lifting to be able to connect and take advantage of it. And so I know that, there's been some tension in the industry about, should we sit and wait for Fed now? Should we jump in? And our message at Jack Henry is that, in order for you to be able to compete, you need to be able to connect now to RTP and have the capabilities to receive those transactions, because the larger financial institutions that are already part of the RTP network are working with big insurance companies, gig economy players, and those transactions need to have a place to land. So we need that ecosystem, right? As we say at the U.S. Faster Payments Council, you need that ubiquity. You can't send a transaction and have it settle unless there's a player on the other end ready to do that. And so we're encouraging our financial institutions to get into the market and play.
But there's real things like the ability, since all the systems are batch, the real things say, I got this real-time payment, I need to reconcile this across everything in the bank, and I need to be able to apply it to another obligation I have. Most people cannot do that real time.
Well, I would say, Hans, irrespective of whether or not Jack Henry's changes are revolutionary or great in the market, the one thing that I can predict with almost complete certainty is that there will be additional core options that will be based on the most advanced technologies and will offer the opportunity of lowering cost, increasing speed for smaller institutions, for community and regional banks. That's going to happen. And it will be a competitive landscape that we haven't seen in this part of the market for 30 years.
Yeah.
That I think.
And I was going to get to this point in a second, because I think that I would say I was always against it, but there are new core models which can speed this up. And then I also would say there's what we call wrappers. So like Blend is a wrapper, Personetics is a wrapper. You don't change, you leave your system of record exactly as it is. You apply a new data layer on top of that, which syncs with your system of record, and then you build new applications on top of that. And what that can do is it can get you into business with modern applications in literally weeks or months rather than years. But I also believe, I agree with Gene, there's half a dozen really interesting new approaches to cores. So I think this is one of the most important developments that's going to hit the banking system. And the reason why, another reason why this is so important is you got to get your costs down dramatically.
Absolutely.
And it's like hundreds and hundreds and hundreds of millions of dollars that you need to do, and also speed up your development. You can't say, well, we're going to have this in 2 years. I see that as pretty irrelevant right now for your
and it's a tricky business. I was just involved in the first bank-centric public cloud first step development. And what makes it bank-centric, of course, in large part, is really meeting regulatory needs, as well as other things that are peculiar to the ecosystem of banking. There's no way you can take advantage of these technologies without doing that sort of thing. But the fact that we can now do them, again, to go back to my image, is transforming. We're going to see a lot more competition in the marketplace. It's going to be an exciting time with a lot more products offered over the next 10 years.
How do you deal with the fraud risk?
Well,
Are you
need
talking about
real-time fraud
AML
systems
generally, or?
Just,
Yeah, fraud, right. My opinion, you comment, the reason limits are low in real-time payments is because there's a real concern that the banks don't have real-time monitoring system, account takeover monitoring. So those are all things that they're, I'd say, working on. And then also, corporations are not real-time either. So they have a batch SAP system. They can't reconcile their cash real-time. So the infrastructure on both the sending and receiving side has a lot of work to do to really make the most of it.
That sounds like opportunity.
Yeah, that's exactly. No, Betsy, you've hit the jackpot in terms of, as you often do, because that is why you have to have these technologies in a bank-centric, sort of, big, like you're thinking of the old safe in the bank, all made of iron. You got to have the thing built so that you're not going to have that explode in your face. And that's puts a layer of excellence on top of the fintechs, which they haven't had to date, nor has big tech had to have it. right? You can see that in privacy. You now can see it in discrimination because there's been no requirement that they've had to live with. But that will change.
Your point is sort of the converse, inverse, whichever it was, of the point Hans made. I think it was Hans made earlier, right? That if you're a fintech, you have products. If you give control, if you give the interface with the customer over to the bank, you can't control that interface. You're looking at it.
I was actually saying even the back end. If you give the back end over to you can't innovate. You have the same issues that the bank is. If you're issuing, if web bank is your issuer, you have to go through the exact same process.
But those are very much in tension, right?
Yeah.
Your perspective and what Gene is talking about is the ability to control from a compliance perspective.
Right, and it may be, Mitch, it may be that the rent-a-bank model, which has been used forever, becomes the model of the future. That whether it's big tech or some other industrial company does more rent-a-bank, and the bank is in a sense that little protective layer. I don't think that's right. I think that the banks are not prepared to give up their franchise to the new the tech companies, nor do I think giving up the franchise will work. I mean, having a very little funnel through all of which this goes and somehow protecting consumers and protecting fraud risk, et cetera, through the little funnel that is the little rent-a-bank or even a bigger rent-a-bank.
And actually, the rent-a-banks are small, and it's a weak link.
It's a weak link.
Yeah,
so I think the natural tendency, including in the regulatory community, will go the other way. As banks ingest these technologies and modernize the big funnel and with the big responsibilities, that's where it ought to go. And frankly, I just can't beat this drum loudly enough because I think it is absolutely outrageous. The regulatory bodies have to help us in terms of making sure that we don't continue to have a growing non-regulated financial community that will take advantage of the customer. It's going to come to no good. But the longer it goes on, it hurts profitability in the banks, it hurts competitive realities, it's a bad thing.
So
And that doesn't mean more regulation for banks, quite the contrary.
Yeah.
Now, honestly, I actually believe that financial institutions can work with the fintechs as long as they maintain those relationships with their customers, because the first time something bad happens, try to get a hold of somebody at Google, try to get a hold of somebody at Facebook, and if you look at the next generation of customers, your Gen Z folks, they're very concerned about data privacy. Who among us actually believes that Facebook is taking good care of our data? At the end of the day, a lot of this is going to come down to trust. And so I believe that financial institutions need to continue to foster those relationships and beat the drum about how they're the trusted partner, whether it's a security issue, whether it's about fraud, whether it's being there in that moment of need. That's how we're going to win the battle.
So the first, this is a new technology from my perspective. It's probably supported in the background by Jack Henry. Will the average consumer be able to differentiate between a payment system of banks and one of big techs? And if not, what is the risk of distortion of the level playing field if non-bank systems are not regulated in the same way? It's very apropos of the conversation we've just been having.
I think the processes, I would actually say any of the fintech, if you're engaged in a certain function, that function's regulated. And almost invariably, the companies aren't regulated. So big difference. I went through this myself when we merged with Citibank. We're saying, wow, now I know what it feels like to be regulated. It's very different. But if you're a payment processor, you're subject to all the payment rules, and there's no difference. And I'd say, look, third-party technologies, whether it's Jack Henry or ACI or First Data, it's been 50 years of having tech companies, IBM, supporting financial institutions. And so if you say, well, Stripe processes through Wells, I believe, right? And Amazon processes through Chase. And so they're part of it. There is not a single payment processor that isn't ultimately a bank. You have to be a bank to be part of Visa.
On the pure payments, if you take things like Libra, I think at the end of the day, the Federal Reserve is not going to give up the control of the payment system to non-banks. I think there will be attempts. Modern technology has all kinds of wizardry, But at the end of the day, whether it's in digital currency with the sovereignty question, or it's the payments system, which is controlled the
Bank Secrecy Act, AML, all that.
I just do not think the regulatory agencies they've been slow to get into the game, because that's typical of regulatory agencies, right? There's innovation, then there's regulation. There's not regulation and innovation, and so. But I don't think the governments around the world, particularly here, are prepared to give that up. So we'll see it.
Yeah, so I did see a moderately interesting item reported in some paper this morning that I read on my iPad, that the Fed, while they're not implementing a digital currency system, they're at least thinking about whether they should do so, presumably for these same reasons. If we could, another question has come up. We'll do this one because it's relevant to what we're talking about right now, and then there's one more we'll go back, which touches on a topic that Betsy and Tom raised earlier. Should real-time payment systems let renter banks join to give tech companies greater access to the payment system? Does that exacerbate the regulatory level playing field problem? We were just talking about that very topic. If anyone wants to respond to the question or feel we already have.
I think it's inevitable. Yeah, I think they should, and I think they will. I mean, I think whether Chase or Bank of America are saying we have APIs to corporates. They're saying this is your access to real-time payments. So if they could do it, someone else could do it, and so I'd say that's happening right now. APIs are live.
The third question, it's actually the second question, but the third I'm coming to. Both Betsy and Tom raised the issue of ownership, institutional ownership earlier between active and passive players, and so someone either picked up on that or is really it is burning to know the same sort of things and your views on that topic and how it's affected the way we view the industry.
So the change in that area is at a speed that's probably the greatest in our lifetime. So since 2006, $3 trillion has gone into passive funds and $2 trillion has come out. We actually came out this morning with a review of the banking industry, and on average, a little bit over 20% of banking companies' ownership comes from these passive or index funds. I think if you add quantitative strategies on top of that, it's even higher, and there are some companies where ownership is about half. So that has big implications for how stocks trade. And if you look at the fund flows after the presidential election, the first thing that happened was about $23 billion of funds flowed into financial services ETFs. Since that time, $17 billion has come out. Now you can see the whole movement in bank stocks.
And following, to your point, right, or drawing from that point, this isn't just about, large cap institutions that are in the
It's more significant in the mid and small cap. It's all cap. But I think it's got big implications for how your stock trades and how it's valued in the marketplace. And I think emotions around themes are going to drive stocks more. And then corporate governance. It used to be that the most important letter on Wall Street everybody wanted to read every year was the Warren Buffett letter. And then now you got to read the Larry Fink letter, because he's going to tell you how he's going to vote corporate America shares, because he's got what are the issues that are important to his firm, because there are a handful of firms that own a big slug of corporate America, and a lot of times the managements of corporations, banks, and others aren't having regular dialogue with these investors, and so if there's a moment of stress, I think it increases a little bit of uncertainty into corporate governance in America, which I don't think right now is a great positive outcome and is still being worked on and figured out. And you saw this week the SEC came out with some proposals, and there's a lot of debate around it. But I still think we have to answer this question: are we happy with more and more of corporate America being owned by fewer and fewer entities?
I think it also gets back to, if you can control it, you got to double down on that ability, because you're influencing a smaller and smaller group of your investors, but investors who are more incented to work with you and understand how you're actually positioning and what kind of time frame your efforts and execution is going to occur over. It gets back to the operating leverage issue. You can control the expenses. If you can develop a strong track record and an understanding of by the active investors that this is your plan, and if you have to reinvest a lot to get to a 3-year goal, make that clear. Because that's how you'll be able at least to get those incremental actives who are still the majority of the investor population, but a declining percentage, get them to partner with you and understand your vision, your values, and where you're taking the company on the operating leverage trajectory. To me, that's even more critical than in the past.
Okay, the clock gives us 27 seconds to go. Now, there's a very controversial question that's been asked, and I'm not sure whether or not to ask it. And I'm going to actually ask the entire room. We should have a show of hands. Does anyone think digital currency is a good idea?
Well, wait. What's digital currency?
Well, that's part of the problem.
I mean, is Zelle digital currency? Zelle is digital currency to me.
Fed wire is digital currency. I mean, Fed wires are replicable 22 and a half hours a day. Any dollar size is just like it's that type of efficiency, which is you can at very low cost, very quickly transact, and that will continue. There'll be applications of digital ledger.
The one thing marvelous about this question is it could have been asked 25 years ago when people said electronic currency is coming tomorrow. Hopefully, we will all be here together, this marvelous panel, looking just as young 20 years from now, and you'll ask the same question.
Actually, Walter Wriston's book was titled Digital Money, and that I think was
40 years ago.
Yeah, exactly.
There you go.
Well, that's the last word. Thank you all so much for your attention. It was fun for us, hopefully for you.
Thank you.
All right, I'll take it. Ladies and gentlemen, that concludes this panel session. Please enjoy a 15-minute break. Thank you.